Your home isn't just a place to live, it's probably your biggest financial asset. And tapping into its value, that can be a total game changer for your goals. But there's a hidden catch, a surprisingly common fee that can cost you thousands. So today, we're going to break it all down and show you exactly how to avoid it.
So, you've been paying down that mortgage, right? Building up all that equity, and now you're thinking, hey, how can I put this value to work for me? Maybe you're dreaming of that new kitchen, or you want to crush some high-interest debt, or maybe even fund a new business. Whatever your big idea is, you're ready to make a move.
And, a home equity loan, it seems like the perfect tool, doesn't it? It's a pretty straightforward way to get a big chunk of cash, and usually at a pretty good interest rate. But, and this is a big but, there's a potential catch lurking in the fine print, a hidden fee that can pop up when you least expect it. Yep, we're talking about prepayment penalties.
All right, so to steer clear of this trap, we've got to understand the tool itself. So let's start with the absolute basics. What exactly is a home equity loan?
The easiest way to think about it is like a second mortgage. You borrow a lump sum of money against the value you've built up in your home. In return, you get a fixed interest rate for a set amount of time. And that predictability, it's awesome for budgeting because you know exactly what your payment is going to be every single month. Plus, since your home is the collateral, lenders see it as low risk, which usually means a better rate for you.
But that predictability can have a string attached. What happens if your life changes and you find yourself wanting to pay that loan off ahead of schedule? Let's dive into the trap you really need to sidestep, the early repayment penalty.
Basically, think of it like an early exit fee. See, your lender was counting on you paying interest for the full term, say 10 or 15 years. That's how they make their profit. So when you pay it all off early, they lose out on all that future interest they were expecting. This penalty is their way of getting some of that money back. It's a clause that's often buried deep in the paperwork, and it's really easy to miss when you're just excited to get your loan.
And this quote right here, it paints a perfect real-world picture. Imagine you take out a loan, do a huge renovation, and it adds a ton of value to your house. A year later, you decide to sell. Well, when you close the sale, you have to pay off that home equity loan. And that's exactly when this penalty can sneak up and take a big bite out of your profits.
Okay, so what does this penalty actually look like when it comes to real money? It's not always a straightforward number. Let's break down the two main ways this fee can show up.
Usually, this penalty comes in one of two flavors. Sometimes it's a simple flat fee, but more often it's a percentage of your remaining loan balance, and that can really add up. I mean, a seemingly small 2% penalty on a $50,000 balance is still an extra $1,000 you have to fork over. That's why it's so important to know exactly how your lender calculates it.
And this is the part you absolutely have to get. There's no industry standard here. It's the Wild West. The penalty landscape is all over the map. Some lenders have really steep fees, while others have little to none. Some even have a penalty that just disappears after the first 2 or 3 years of the loan. This huge variation is exactly why you have to do your homework before you sign anything.
Okay, enough doom and gloom about the problem. Let's talk solutions. Here is your clear, step-by-step game plan for protecting yourself and avoiding these fees altogether. First up, compare lenders. When you're shopping around, don't just look at the interest rate. Make the prepayment penalty a major point of comparison. Second, just ask. Be direct with your loan officer. Say, what is your policy on early repayment? Can you show me exactly where that is in the agreement? And third, and this is the big one, read your agreement. You have to find that clause in the fine print. If a penalty exists, it will be spelled out right there.
But what if you know there's a good chance you'll pay the loan off early? Maybe you're expecting a bonus from work, or you're planning to sell in a few years. If that's the case, a different financial tool might be a much better fit. Let's talk about the Home Equity Line of Credit, or HELOC.
So this table really breaks down the key differences. A home equity loan, as we said, is that one-time fixed-rate lump sum. A HELOC, on the other hand, is more like a credit card that's secured by your home. It's a revolving line of credit with a variable interest rate, so you only borrow what you need when you need it. But look at that last row. That's where the real strategic advantage is for avoiding penalties.
And here's the really clever part. With the HELOC, you aren't technically closing the loan early. You're just paying the balance down to zero. As soon as you've done that, you stop paying interest. Then you can just leave the line of credit open until its term ends naturally, on its own. This is how you sidestep those early closure fees that some HELOCs might have. It gives you some serious flexibility.
All right, let's pull all this together and talk about the bottom line, what this all means for your wallet and your financial game plan.
Now, If you already have a home equity loan and you're thinking about paying it off, this is the critical question you have to ask yourself. You've got to do the math. Let's say the penalty is a flat $1,500. Okay, now calculate the total remaining interest you'll pay if you just let the loan run its course. If that interest adds up to, say, $4,000, well, then paying the penalty actually saves you $2,500 in the long run. Sometimes, taking that hit up front is the smarter financial move.
So here's the biggest takeaway from all of this. The best deal isn't always the one with the rock-bottom interest rate. True value is in flexibility, having the freedom to adapt to life's changes without getting dinged with a penalty. So before you sign on that dotted line, ask the right questions and read the fine print. At the end of the day, being an informed borrower, well, that's your superpower. Thanks for joining me.